today we have a lot to cover, and I want to start out with the last homework assignments for the valuation and recommendation for Whole Foods. So what I have on the screen is the data to do what we would call the baseline, preparing to do the as-is. Right? So what you should have done is you should have taken the model data from Bloomberg. You should have overwritten the model data tab, making sure there were no dashes, got rid of all the zeros, or zeros for dashes. You should then come into the assumptions tab. You should have updated the WACC. If you had changed the G, probably put it back to 3% as a starting point. Put in the current shares outstanding off the DES screen. I used a share price from this morning of 30.42, but it's going to be somewhere around that range based on when you did this. And then putting in the Bloomberg estimates for revenue and EBITDA for the next 2 years. You should have then gone to the ratios tab, and I started to do my solution based on the model we did for Delta. So we want to make sure that any of the fields that were in yellow that we changed for Delta, we would have probably needed to undo. So for example, I just took whatever the 2017 and equaled it going forward, because if you remember, we had EBITDA margins for Delta at, I think, 21% or something like that. And we had, so I set them back to be more realistic for Whole Foods at 8.4, at least as a starting point. And same thing with the tax rate. We had hard-coded in 37.5% for Delta. And looking at Whole Foods, I actually used an average of the last 6 years again, and then equaled that out on a go-forward basis because I thought that it was more representative. But at least as a starting point, getting the file ready to do the as-is. And again, I call this the baselining process, but regardless, you would have had to get to this point to do the process for Whole Foods. So the real question becomes, how did you get from 36 and change to around 30, which is about where they're trading today? So what did you guys actually do to get to that, and what was the rationale, what was the why? So anyone want to share their thoughts on the as-is? Yeah.
So I thought that 3% and 6% for 2016 and 2017 were pretty accurate, considering that Whole Foods markets have been on a downtrend for the past 12 months.
Yep.
And there's been a lot of, now that the healthy eating index has been picked up by a lot more different grocery stores like Harris Teeter and Wegmans, and they provide more options. I wonder if Whole Foods is even sustainable anymore, and there's a large consumer criticism of Whole Foods being very expensive. And even though there's a lot of talk of whether or not the economy is in a better place or not, it's going to be hard to justify having higher revenue margins or even an EBITDA that's that high, considering that they have significant competition and that the economy still doesn't have as much disposable income as a lot of people assume.
Okay, so a lot of good stuff to unpack there. So what kind of revenue growth rates and margins did you use to get to the as-is?
I used about below a 4% revenue, so 3.7 to about 4 on revenue, all the way from 2017 to 2021.
Okay.
And then I lowered the EBITDA from 8% to about 7%.
Okay. And did you use other data to support that, or was that just kind of your conclusion based on what you had said?
Well, there in the IBIS world, there was a report from U.S. grocery and U.S. stores that was basically talking about economic drivers.
Yep.
And whether or not they're changing.
So I guess what you're referring to is, and this is good because you'd want to, get some industry data. And Whole Foods in IBIS, when I was looking at this, probably straddled two industries. One was grocery stores, and you can see that grocery stores over the next 5 years, IBIS is predicting basically between 1.5% and 2%. And then the other ones was specialty foods, which IBIS had predicted at, where's the number? Around, again, 2%, 1.7, 1.2, 1, and 1.4. Now, the reason why I said it's straddling is because IBIS is saying specialty foods is a $9 billion business, And last year, Whole Foods is already expected to be a $13 billion business. So obviously, Whole Foods is more than a specialty retailer, but by looking at the two, at least we're getting a sense of very low single-digit growth. And then it's just a question of competitive advantage. Is Whole Foods going to grow faster than its peers because they have competitive advantage? So that's what I'm saying. These are how you start to tie the dots together. You did mention they have a brand problem. As a matter of fact, does anybody know that the nickname Whole Foods has earned? I don't think it's a loving nickname. They're called whole paycheck, right? So there's a perception that they are expensive. As a matter of fact, did anybody see the spoof on Last Week Tonight with John Oliver? You didn't see it about what was it, asparagus? Let me see the asparagus water thing. It's very funny, by the way, and unfortunately, it's very damning for them. But basically, they were selling for $6 a jar 2 pieces of asparagus in a jar of water. They were calling it asparagus water, and it made national news because they were basically saying this is just another example of how Whole Foods is kind of ripping you off. They're calling it this healthy stuff, but it's really just 2 pieces of asparagus in a jar of water. And they found it at some Whole Food stores. They apologized for it. They took it out. They said, sorry, we didn't do this. And somebody in the last class mentioned, I have no way of validating the story, but they said that they were now selling recently oranges where they actually peeled the skin off the oranges, and they sold peeled oranges for a very high premium price. So I'm just saying, like, this is the perception brand issue that they have to deal with. I also think they have to deal with some other competitive issues, meaning, as you pointed out, you have traditional grocery stores. You mentioned Harris Teeter and who's the other one? Publix. You got Safeway. You got Giant, which is like, I forgot who they're owned by. But the point is, you got all these grocery store chains, and they're also getting into these premium branding foods. You have a bag of bread from Whole Foods?
Yes.
Okay, I assume it's more expensive than the bag of bread from...
It tastes better.
It tastes better? Okay, so it's better for you. So, but that's the thing, is these other grocery stores are not sitting by, and they're attacking them. Matter of fact, who's another competitor of Whole Foods?
Trader Joe's.
We just mentioned the traditionals, but who else? Trader Joe's, exactly. And I was mentioning in the other class, does Aldi own Trader Joe's or Trader Joe's own Aldi? I think Aldi owns Trader Joe's. Does anybody know who Aldi is? It started as a German grocery store, but what is basically Aldi? Has anybody been to one?
Yeah.
So what is Aldi?
It's all knockoff. Like, it's like they have like really. It's like instead of like Rice Krispies, it's like crispy rice.
Okay.
Like that sold in the store.
So it's like the generic brands at a fraction of the traditional price, and then you have Trader Joe's, which is Whole Foods for 20% less. So basically, you also have the peers, which are going out. You can have organic cheap, or you can have not organic cheap. But either way, people have been noticing what Whole Foods are doing, and they're losing some of their prestige. Now, I'm not saying that this is necessarily going to continue in the future, but these are some of the things that we would need some data to address. What's another issue with Whole Foods relative to sales? You mentioned slowing sales. What else is going on with Whole Foods? Yeah.
With the slowing sales, they're now expanding into a new type of store.
And what's the new type of store going to be called?
365.
Yes, they have a 365.
They're private label mainly that they're going to sell, which is higher margin.
But what is the concept for the 365 stores?
Smaller, more efficient in downtown. Right?
Okay. So what's the potential challenge they might have with these 365 stores? Yeah.
It might cannibalize their sales from the general.
Yeah, so that's one of the questions, which is, will these new small concept stores, if they're near the traditional flagship stores, will they actually lead to more growth, or people are just going to go to the lower cost, smaller store concept, and does that really help them grow? Somebody, again, in one of the previous sections mentioned, I didn't validate this, but I seem to believe they had done some research, and they said basically the amount of stores they're opening also slowed dramatically this year. So they're already opening up many fewer stores, the traditional stores, while they're thinking about this rollout, which is potential cannibalization. So I say this because when you're doing your assumptions, it would be helpful to kind of have that level of knowledge for Whole Foods as you help to create the forecast for sales and for margins. Right, but the gist of it is lower sales than they're currently having and lower margins than they're currently having the next 2 years kind of gets you to the as is. All right, so given everything we just kind of mentioned, where did you guys fall out in your target? Are you a buy, or are you a sell, or are you a hold?
Hold to sell.
All right. Is anybody a buy? All right. What is your buy story?
Well,
And remember, there's no right answer here as long as it's kind of opinion based.
so in the last season of South Park, sort of Whole Foods was sort of symbolized as like the iconic like foundation of like the new yuppie sort of identification. So I thought that like Trader Joe's won't do, other stores won't do a substitute for like a foundation of like redevelopment and stuff. It's like iconic. So people will continue, they might continue to open new stores and maybe communities will do some tax breaks or something.
Okay. So basically, you're saying that Whole Foods is going to open up more stores, and
They won't slow down as drastically as as is.
okay. And so when you did that, what kind of sales growth and margins were you using in your model? Just approximate. Don't need actual, just ranges.
The terminal was still 3, I think, but there's like gradual decline.
Gradual decline of,
7, 6, 5, 4.
and what kind of, and margins?
I think I put like the average of the last 5 years and just put lower.
Okay. And that got you what kind of price?
41.
Okay. So that's how you got to the buy. All right. And today they're at what, 30? What was it, 30 and 50? Something like, it's about a $10 upside. All right. So again, obviously, I appreciate the pop culture references. I like that all the time. I hope we get more than South Park as our rationale. But basically, what you're really saying is that they're generating as a premium brand faster growth and maintaining margins at a higher level than what they're, looks like it could be projected to get to the as is. So that's what you're trying to justify in your statement. Who's on the sell side for Whole Foods? Anybody to sell? Like get out? Yep.
I said so.
Why?
Because I didn't think that it was going to grow significantly in the upcoming years. If anything, it was either going to stay pretty constant around the $30 range, or my forecast was decreasing to like around $28. Something like that.
So again, what were the rationale for the decrease?
It was similar to how I think there's so much competition coming up, and I talked about how like club stores like Costco and even Target and things like that are all entering the organic specialty market, and I think they're losing their competitive advantage. So they're basically just an overpriced grocery store. So in my mind, I didn't really see that changing in the future, and I thought there would be even more competition.
Okay. All right. So again, just quick show of hands. How many people are in the buy side? One, two. How many are on the sell side? 1, 2, 3, 4, 5. So I assume everybody else is more in the middle of the hold. What's interesting is if you look at the analysts, and if I go back to Whole Foods today, you're actually pretty representative of where the actual analysts have turned out. You got 3 buys, 3 sells, and 25 holds. And I think that's about the type of distribution we're looking at for the room right now. So I personally would probably be on the hold side as well for reasons that will become apparent in about 40 minutes. Right? So in the interest of time, we need to cover multiples today. And I told you last week that multiples would give you some insight into this analysis. And so I want to make sure we have some of this insight from multiples when we do this analysis. So I want to get to that. But that also leads me to believe why I think they're more in the hold category. So with that in mind, let's talk about multiples. We'll come back and we'll talk about Whole Foods. So if you look at I put up lecture note 6, which is the lecture note on multiples. And again, I'm assuming you've read the chapters and the lecture notes are there just to reflect what's in the chapters. So I'm just going to focus on the most important issues because we have to get it through today. So the idea is that multiples, also known as comparables or comparables, are an alternative form of valuation where what we've just done with DCF and economic profit is we've done the idea of intrinsic value, company's worth of some of its future cash flows. Multiples is the alternative that says we're just going to kind of shop and look comparatively against other things to decide whether it's relatively more or less valuable. So if you were to walk into a grocery store and you were to say, oh, I want to buy some cereal, and you see one box of cereal trading at one price and another box of cereal trading at another price, well, it's no different than multiples. And we say, you know what, this box of cereal is not worth it, and this box of cereal is completely worth it. Well, we're doing the same thing, except there's some financial rationale going on here. So multiples analysis is actually very simple. It's just looking at similar things, looking at the prices, and deciding whether or not we think the prices are fair. Right? And that's basically at a baseline what we're trying to do. So here's the advantage. Multiples are simple, and here's the disadvantage. Multiples are simple. Okay? So that simplicity also causes us some problems. So one of the keys and one of the challenges with multiples is what we have to do in a multiples analysis is we need to find similar companies. And as simple as that sounds, it's really hard. Right? And I'll give you an example. This year I'm working yet again with a company called Ingersoll Rand. Ingersoll Rand is Trane heating and air conditioning, plus they make club car golf carts, and they make some security locks. Like if you swipe a card key in a lock, they make some of that stuff. So that's their business. But their biggest business is Trane. Well, the biggest competitor to Trane is Carrier, which is owned by United Technologies. And United Technologies owns Carrier. They own Sikorsky Helicopter, which they're about to sell to Lockheed Martin. They own Otis Elevator, and they own Pratt & Whitney jet engines as their major lines of business. So here's the point. Those are considered comparable companies. Right? So the problem with comparables is actually finding companies that actually do the same thing. And there's very few in today's world of big publicly traded companies that actually meet that criteria. So what increasingly we have to do is we have to find companies that have similar growth and risks, growth and spreads, and ROICs, rather than just similar businesses. That's what's more important. As a matter of fact, if we were doing Google, we would not use LinkedIn as a peer of Google, even though some people will do for simplicity, because Google has a far different growth rate at a $60 billion company versus LinkedIn, who's still tiny and early. They have a much more defined model. They have a different risk profile. And so therefore, even though people would say, oh, they do similar things, well, yes and no. They're really not as comparable as people would like them to be. So doing this analysis is often hard and comes up with what I would call dirty comparisons. So that's just something we're going to have to realize we do when we do our multiples analysis. But it's more important to do multiples based on a good selected peer group. And we can't use historical data, meaning multiples are based on forecast multiples or forward multiples, because we care more about forward cash flows, right? So we need to be able to get prospective multiples on estimates to really sync up with our prospective valuations. So you can't use Yahoo Finance to do this. That's why you need a tool like Bloomberg. So there's also something called, by the way, precedent transactions. Those also are a form of multiples. So precedent transactions involve acquisitions. So if I buy somebody, then I would pay a multiple of their earnings or sales to buy them. So it's a different set of multiples for acquisitions than it is for a publicly traded company to buy their stock. By the way, if you ever get into this, Bloomberg has a part of its database. I don't know if anybody's seen it before, but if you type in M&A or MA for mergers and acquisitions, you can actually get almost 10,000 historical deals in Bloomberg by country and by industry, and it will give you lots of deal information, including, so for example, are you guys chemicals? So Westlake, is somebody Westlake in this room? There you go. You just bought a company called Axel Corp today. So there was an acquisition that was announced. And it's a $3.1 billion cash and stock deal. I can drill down. I can look at the deal terms. I can look at the multiples that are paid. These are the deal comps. So here are some previous multiples, announced deals, etc. So multiples can also be on acquisitions. Multiples can be on trading. So we're not talking about precedent transactions here for our Whole Foods analysis, but when Westlake went through the process to buy this other chemical company, basically they probably looked at a lot of these precedent transactions to figure out how much they should pay based on what people have paid for similar assets, because that's the whole idea of multiples. So let's come back to this. So in the interest of time, and again, I'm assuming you read the book, these are the 6 multiples we're going to focus on this semester. They are the PE, the PEG, the 3 enterprise value ratios, EV to sales, EV to EBITDA, EV to EBIT, and something called the price to book multiple. Okay, so what we're going to do is we got to calculate these multiples on a forward basis. Here's the good news. Because the professionals are calculating the exact same ratios, Bloomberg already has these ready to go in its database. So what we're going to do, and you're going to need to do this, is we'll do this for Whole Foods. We're going to go to the RV section, and we're going to create a new template today for multiples. Now, in terms of selecting peer groups, ideally we'd want to find peers of Whole Foods, but being bad analysts, what we're going to do is we're going to be lazy, and we're going to use the Bloomberg selected peers. So by default, Bloomberg will give you peers for the country the company's headquartered in, and we're going to use that peer group as default. Because somebody at Bloomberg thought through and curated this list, so we'll just kind of start with this list. However, you need to have at least 6 companies in your peer group to do a multiple analysis. So if you have a peer group and it has like 3 companies from Bloomberg, you're going to need to add a few more. Okay, so regardless, we need to have this list. This list has 11 companies on it, so we're probably okay. All right, so then what we're going to do is we're going to come over here to custom, and we're going to add a new template. Okay, so you create a template, and then we'll start adding in the 7 columns you will need for your multiples. So column number 1, I'm not going to go in any particular order, but similar to what I did in the previous classes, we're going to do the enterprise value multiples first. So the first one is enterprise value to sales or revenue. So what you'll do is you'll add a column in Bloomberg, EV space 2 space sales. And you'll see that Bloomberg has 2 enterprise value multiples already created called EV to this year's sales, EV to next year's estimated sales. Right? This year is forward year 1. Next year is forward year 2. So based on where we are with Whole Foods, this year is 2016, next year would be 2017. So again, the first 2 forward years are the ones the analysts are looking at pretty heavily, so Bloomberg already has them set up as ready to go fields. All right? And as it talked about in the book, the second year is more normalized, so we're going to care more about the next year's sales, forward year 2. So we'll take EV to next year estimated sales, select that, enter, add that to our template. Okay? Now, don't do this, but there's different ways to get to this number in Bloomberg. So what you could have also done if you typed EV to sales is they have something called EV to best sales. Best means Bloomberg estimates, which comes from the consensus estimate database. I could click on that. I could then say use a customized period. And then I could say use years ago forward, and then I could do years plus 1, years plus 2, okay, or current year. So basically, I can also get to the same data by using this timeline and creating whatever period that I want for doing an enterprise value to sales. Right? So I'm not advocating you do it that way. It's more complicated, but Bloomberg has these kind of predefined ones, and that's what we're going to use for ease of use. But if you ever needed it for a different period, you could do that on a yearly or quarterly basis. All right. So next, EV space 2 space EBITDA. Show more matches, because there's a lot of them. Scroll down, and then you need an EV to next year estimated EBITDA. There's your EV to EBITDA. Select that. Right. Then we need EV to EBIT, EV space TO space EBIT. Again, there's a lot of EBITs in here, so show more matches. Scroll down, and we want EV to next year estimated EBIT. Right? So those are the next 3 EV to EBITs. EV to EBITDA, EV to sales. Right? After that, we're going to need a PE ratio. P/E. And again, we need a estimated PE for best PE for next year. Okay. Then we're going to need Actually, take it back. Let me remove this. In the last class, I just want to keep it consistent with the last two classes. I use the estimated PE for next year. I think it's the same number, but just so you have the same field names. Okay? All right. So, next we'll need what's called the price to book multiple, P/B. There is only one price to book multiple that's current, meaning you don't really forecast a forward price to book because it's current market price divided by book value. So it's hard to do a future market price. Right? So this is price to book multiple today. And then the final one is called the PEG ratio, price to earnings divided by the long-term growth rate. And what we want is the best estimated PEG ratio for next year. So next year's PEG, the 2017 PEG. And what the PEG is based on is it's the forward PE divided by what's called the long-term growth in earnings per share. Now that's different than the CVG. The CVG in our key value drivers model is the growth of free cash flow into perpetuity. Right? The estimate for long-term growth is the growth in earnings per share for the next 5 years. Right? So the analysts are using a different number for growth in earnings than they are for growth in free cash flow. So in this case, to help you, I'm adding a seventh number, which is type in LTG, just so you know what the long-term growth rate is that they're using for EPS. So use the best estimated long-term growth rate. Okay, so that's growth in earnings per share for the next 5 years. Okay, so that's the template. Save the template as something. So save as, name it. So multiples bid, and then it'll add it to this list across the top. Okay, so you can always use this template anytime you bring up a company. So you'll need this to complete the next upcoming assignments. Yes?
How do you find the EV dot?
Just again, when you create a template, just EV space TO space EBITDA, and then you got to show more matches and scroll down just because there's a lot of EBITDAs in here. And then here it is, EV to next year's estimated EBITDA. Yes?
What was that last metric, the best long-term growth rate?
So eventually we're going to use a long-term growth rate for EPS just to help you with the analysis we're about to do. So if you type in LTG, which is long-term growth rate, then best again is Bloomberg estimate, and we want the best estimated long-term growth rate. Okay, so that's what's going to be used as part of the PEG ratio. The PE divided by the long-term growth in EPS. So in this case, that's the long-term growth for EPS. It's not the long-term growth rate for cash flow. We're going to assume they're directionally correlated, but they're actually different numbers. Good questions. Other questions? All right, so you got your template, you save your template, and you'll be using your template. Let me come back to this one. Okay, so we got my template. So now I want to start doing some analytics. So let me go back to our PowerPoint and the book readings for this week. So we're going to start out with the concept of key value drivers. So using the key value driver equation, NOPLAT times 1 minus growth over ROIC divided by WACC minus G. So here is a NOPLAT, 100. Here is a WACC, 10%, right? And then here are different growth rates, different G's and different ROICs. Running them through that equation, we get this table. Okay, so it's just a table of results, putting those numbers with those different growth and ROICs through the key value driver equation. That would be the results. Okay, then on the next slide, enterprise value to EBIT. Okay, so here's the point. Let's assume a tax rate of 35% for simplicity. If I have 100 of NOPLAT, then I'll have 154 of EBIT. Because EBIT times 1 minus the tax rate equals NOPLAT. Therefore, NOPLAT divided by 1 minus the tax rate would give us what the EBIT had to be. So I'm just solving for the EBIT of 154. Okay? So here's enterprise value to EBIT. The results of the key value driver formula divided by EBIT, that table is what you get. So these are the multiples of EV to EBIT. Okay? So here's the key. Definitionally, Bloomberg and most people, when they define enterprise value, what they're doing is what we would call operating value. So the definition in the real world for enterprise value is similar to what we would call operating value in our Modigliani-Miller rearranged world. Therefore, when we calculate the key value drivers formula for ROIC, growth and free cash flow, and WACC, what we're actually calculating is what Bloomberg and others would call enterprise value. So enterprise value to EBIT, use the key value drivers, divide by EBIT, there you go. So here's the point. This divided by that equals that. So we have a data point, publicly traded data, and then we're working backwards to understand what drives key value drivers. Basically, in the key value drivers equation, three things matter: growth, return, cost of capital. So really, what multiples are a representation of growth and spread. That's multiples. All right? So here's the idea. Company, look at the table on this slide. Company trades at 6 times EBIT. Competitor trades at 7 times EBIT. What can we tell that's different about those two companies from those two multiples? So we got a company at 6, we got a company at 7. What do we know? Or what should we know? From this table. Yep.
Seven's growing faster and has a higher return on invested capital.
All right, let's focus on the higher return. Why do you know it has a higher return?
Because 7 is going off the 7 over the rate.
So here's a 7, here's a 7,
And the 6
somewhere in here's a 7. So first point, when you see a multiple, it's actually a range. A multiple represents a range of growth and spreads. It doesn't represent one absolute number. So just as when we did the as is, we tried to figure out what is the range of growth and margin. With a multiple, we're kind of doing the same thing. What is the range of what the growth and spread could be? But in either case, given this data for the tax rate and the EBIT, we kind of know that it's relatively low growth, but it has a positive spread relative to cost of capital. What can we say about the 6? Where do we see 6s on this table? Well, here's a 6, here's a 6, probably this way. So here's my 6s, and here's my 7s. So what can we say about the 6? This company trades at 6 times EBIT in this industry. Yep.
invests at a worse rate than its competitor.
Not just a worse rate, negative spread. So here's what I'm telling you is hiding in plain sight is data about the spread of the companies going forward. Now, very important. It's not the current or historical spread. Multiples, since we're using forward multiples, are about expected spread in the future. So you can't just go look up the current ROIC of the company and say that's the trading multiple of the company. May be different, right? So multiples give us hints into spreads and growth rates. So in this case, we know the company trading at 7 has a higher spread than the company trading at 6 for about similar growths. One's positive spread, the other's negative spread. Yeah.
How do you know it's negative?
How do I know it's negative? Because I said the cost of capital is 10% on the previous slide. So 10% is the dividing range. Okay? And by the way, 10% would be a multiple of 6.5. So that's what's important for us to start to assimilate, right? That's why, FYI, when you first learn how to do multiples in your first corporate finance classes, you learned it in what I would consider to be a very naive way. Right? You got to start somewhere, but this is getting much more advanced. So what you say is, well, everybody's going to eventually trade at an average multiple for an industry. No, it's not the case. Like, if you have an average multiple, then you have an average growth and an average spread. That's an average multiple. If you don't have an average growth and an average spread, that you don't trade at the average multiple. You'll trade at a discount or a premium based on your expected growth and your expected spread. And that's what will explain multiple differences across companies. So, continuing on. The next multiple, EV to EBIT, EV to EBITDA, are relatively similar. Okay? But the next multiple is something called PE. So how do we get to PE? Well, again, key value drivers formula, except rather than using NOPLAT, we use net income. Rather than using ROIC, we use expected ROE. Rather than using WACC, we just use cost of equity. And rather than using growth in free cash flow, we use growth in EPS. So that is the key value drivers formula to do market value of equity. So, on the next slide, running the key value drivers formula with $100 of income, 10% cost of equity, growth in EPS, and expectation for ROE. Here's the values. Those divided by 100. Here's my PE multiples. So the same thing applies. What's the difference between a company with a PE of 11 and a company with a PE of 9? Okay, I'm asking you the exact same question. The company with a PE of 9 would have a negative spread. The company with a PE of 11 would have a positive spread if we were to do the key value drivers. Now, as I said, what we're generally going to do is we're going to work directionally, because unless we pull out the formulas, at best we're still going to get a range, but that's the insight that we will start to get. Now, to further help you do this, we go to the next multiple, and that's called price to book. It's also at the bottom of this page. So, what would cause a company to have a price to book multiple of 1? What does it mean to have a price to book of 1? So I'm kind of the third multiple here. So what is price to book again? Yeah. So the shareholders' equity, the value, divided by the book value of equity are equal. So the market value and the book value are equal. So what would cause it to be equal? You're neither creating nor destroying value. 0 NPV. What causes that condition to happen? When do you get 0 NPV? Yeah.
When the discount rate is the same as the IRR.
All right. So therefore, the IRR in this case is the return on equity, and the discount rate is the cost of equity. So back to spread of 0. So spread of 0 is a price to book of 1. So here's the beauty of the price to book multiple. Price to book multiple is the most elegant way of expressing expected spread. When the price to book multiple is 1, your expected spread is 0. When the price to book multiple is above 1, your expected spread is positive. When the price to book is below 1, your expected spread is negative. All right? So let me give you an example. I work with a lot of banks. Banks have unique valuations, so we're not going to talk about it too much this semester. But here's the point. Let's go back to Bloomberg. And let's go to one of the largest banks in the world. Let's go to HSBC. So here's HSBC today. And let's go to our little RV template. And banks don't really have enterprise value multiples, so you're going to see some missing data points. But if we take our little template that we just created, just focus on price to book. HSBC's price to book is 0.64, which means they're trading at 64% of book value. Why? What do we know about HSBC from that one number? They have a negative expected spread. So then, let's go to their WACC. And their cost of equity, because it's based on equity, is 10.6% today. And then we go to the EEO screen. And the return on equity for HSBC for the next 3 years, 6%, 7%, 8%. So what I'm telling you is before I even went to the EEO screen, I knew what I was going to see. I was going to see a return on equity lower than their cost of equity because they're trading at 64% of book value. So that's what I mean by working backwards from the price to book. It's giving you data as we're starting to think about a company, but what the market's expecting going forward before you even actually do the math. And so this helps us as we understand the valuations and helps us understand what the market is thinking about the value. So one of the things I know about HSBC is the market's worried about their spread going forward, and that's why they're trading at a discount. So that's the good news for price to book. Here's the bad news for price to book. It's also the most susceptible ratio to being what I would call dirty and giving you misleading information. So I'm going to go to another company. Let's look at Lockheed Martin. Lockheed Martin, RV, custom, multiples. So here's the point. Their price to book multiple is 21.92. It's ridiculously high. Industries between 1 and 3, they're at 22. Right? Why would they be at 22? And the answer is accounting distortion. So Lockheed Martin's been around for over 50 years. It's Lockheed, etc. They got a lot of older workers who they also have a pension. And they fund their pension by funding the pension assets. Well, 2008, when the stock market collapsed, the value of their pension also collapsed. So what the accountants do is they write off the asset, because the market value went down, by writing off the equity to keep the balance sheet in balance. So 2008, 2009, Lockheed Martin had giant write-offs of equity because the pension assets went down. But subsequently, the market since 2008 has more than recovered to higher than pre-crisis levels. Well, the value of those pension assets has gone up dramatically. But the accounting rules do not let a company write up the value of the pension assets. So Lockheed Martin had its equity wiped out, but they can't mark to market the new high prices. So therefore, they have a distorted price to book. Yes?
So how valuable is like the price to book ratio when you're considering to invest in a company?
When it's dirty, terrible. When it's clean, good. But here's the thing. How did I know it was going to be clean for HSBC? Because banks are allowed to mark to market the value of their assets. Traditional companies are not. Okay, so basically price to book is better for banks than it is for non-banks for that reason. So that's the point. What I'd have to do is I have to figure out whether companies have been doing lots of write-offs. And I can tell you from looking at this list which two companies look like they did a lot of write-offs historically. Lockheed's one of them. Who's the other one? Boeing. So that's the problem, is I can't use price to book, even though it's simple, because some of these companies did not do major write-offs and they did. And it gets worse because the write-offs that the accountants do sometimes don't even hit the income statement. They make direct write-offs to the balance sheet of equity. So we go to the next ratio. It's called the PEG ratio. PEG is the PE divided by the long-term growth rate. So what it says is, for a dollar or for a unit of growth, how much do I pay? Okay? So what would cause the PEG to be higher? Why would I pay more than a dollar for a dollar of growth? Well, think about what went into the PE ratio. It's the key value drivers. So it's profit, it's return, and it's growth. All right, return, it's growth, and it's risk, cost of capital, divided by growth. So growth cancels out. So what you're kind of left with is spread. So it's growth and spread divided by growth. That's the PEG ratio. So what does the PEG ratio really tell you? Expected spread for the growth. So you have the PB that tells you the spread of the company, and you have the PEG that tells you the expected spread of the growth. So these two should be similar, and if I use to break ties, this is what I mean by you have to look at kind of the tapestry of ratios to see when they're in sync. And when they're out of sync, you probably know you got some accounting issues going on, but when they're in sync, they should tell a similar story. So look at this data. Tell me, do you think Lockheed Martin has a positive spread? Yes or no? Does Lockheed Martin have a positive spread? Yes or no, and why? Because this is going to be your next homework assignment. Yes or no, and why? Price to book, does that give you the answer? Maybe, but it's distorted. PEG, does that help with the answer? What does a PEG of 1.91 tell you? What would a PEG of 1 tell you? What would a PEG below 1 tell you? PEG of 1 means that I basically pay $1 for $1 of earnings growth. Why would I pay $1 for $1 of earnings growth? Yep. Okay, so what does 1.91 tell you about Lockheed? So Lockheed Martin has a positive spread. So let's talk about growth rates. Look at the growth rate of the industry, flower column on the right, 8.94%. Look at Lockheed Martin's growth rate, 8.62. Then look at the PEGs, and then look at the PEs. PE of Lockheed Martin is 16.48. P of the industry is 14.9, 14.88. What can we say about Lockheed Martin's spread versus the industry spread? Is the industry spread positive? Who has the higher spread, Lockheed Martin or the industry, and why? Lockheed does, why? How do you trade at a higher PE if you have less growth? How do you trade at a higher PE if you have less growth? You have to have a higher spread. And how do we know Lockheed Martin has a higher spread that reinforces that? Because they have a higher PEG. So this is what I mean by telling the story together that we're already seeing. Now, we can get out the key value drivers and start plugging some numbers in, but at least at this point, this is, I said, this is advanced, but at least you'll start to understand, like, why is Lockheed Martin trading at a premium, right? Because they have a higher expected spread for slightly lower than industry average growth. All right, and that's why they're trading at a premium. All right. Matter of fact, look at Raytheon. Raytheon's PE is 15.72. Who has a higher spread, Lockheed Martin or Raytheon? I'm sorry? Raytheon. Why? Because their PEG's a little higher. They're similar, but a little bit higher. So similar to a little bit higher. Why is Raytheon not trading at a higher multiple for PE? It's growth and spread. So Lockheed Martin has the higher PE, and Raytheon has similar to higher spread. Why would Lockheed Martin have the higher multiple? Higher expected growth. Look at the best long-term growth rate, 8.6, 7.65. So this is what I'm saying. By putting these ratios together, the market's telling you a story. And you're just playing Sherlock Holmes, and you're figuring out the story. So be Benedict Cumberbatch. Figure this out, right? Because that's what you need to do to help you as you do these models. Does that make sense? All right, so continuing on. So, why enterprise value to EBIT versus PE? Given the choice, most professionals like enterprise value to EBIT over PE, right? And the reason is, even though they tell you similar things, PE is more distortion prone. Why is PE going to be more distortion prone than EBIT, than enterprise value to EBIT? What can distort a PE to give you a different answer than enterprise value to EBIT? That's right. So think about the difference in EBIT and net income. And one of the things is interest, which is going to be influenced by capital structure. So if you have firms with two completely different capital structures, you're going to see a discrepancy between their EV to EBIT and their PE ratio. So if similar capital structures, then they'll be in sync. If different capital structures, they can be different. And so that's one of the things you got to recognize across ratios. What's another big distortable item between EBIT and net income? So one is capital structure. What's another one? Yep. One-time gains and losses, accounting tricks, and gimmicks. They will distort PE much more than they'll distort EBIT. So when a company has extraordinary gains and losses, when they have a bunch of non-operating gains and losses, when they have accounting adjustments, it will distort the PE ratio. So as I said, just like price to book and PEG should tell you similar things, PE and enterprise value to EBIT should tell you similar things. Unfortunately, those two things that we just mentioned lead to distortion. So even though people like PE, because I think it's pretty intuitive for the average person to understand, it's actually the hardest multiple to explain because it's a 6-factor model. There's 6 things that drive PE. It's the 4 things that drive enterprise value, multiples, and then adding on the other 2 things, right? So specifically, it's ROIC, growth, and spread. And so therefore, you have to then explain on top of that taxes, which are part of NOPLAT. But then you got to look at differences in tax structure, differences in non-operating items, and differences in capital structure. So that's what I mean by comparables. If you have similar firms with similar tax structures and similar risks with similar non-operating items, then it's easy. If you don't, it gets much more complicated. And so here is the formula for EV to EBIT. If you want to prospectively create one, here's the key value drivers formula rearranged to the EV to EBIT. And this is what I mean by it's a 4-factor model. Because basically, EV to EBIT is going to be dependent on tax rate, growth, ROIC, WACC. So those are the 4 things that will cause differences in EV to EBIT across companies. So Pfizer is going to reincorporate using a tax inversion to Ireland. Eli Lilly is going to remain incorporated in the U.S., headquartered in Indianapolis. If everything about their business is the same, who trades at a higher multiple? Who's going to trade at a higher multiple, Lilly or Pfizer? And why? Yeah. Go ahead. Why would Lilly trade the higher multiple? No. If you do the inversion, you actually get the lower tax rate. So you're right on the tax rate, just swap the companies. So Pfizer's going to Ireland to pay 10%, and Lilly's going to pay 35%. So that's what you meant to say. But that's what I'm saying is, this is inversion 101 is exactly right here. By doing an inversion, you save cash on taxes. By doing an inversion, you basically trade at a higher multiple, all things being equal. So is it worth it spending a couple $1 million for a tax accounting firm to come in here and change your P.O. Box address with the IRS? Absolutely. Because if you can do that, then you will trade at a higher multiple, and you can run it through this equation and tell you exactly how much of a higher multiple you'll trade at. That's why these U.S. companies are abandoning the U.S. and going overseas and doing these aversions. It's the formula. It's the math. And this is the financial justification they make to their shareholders. We have to fix our tax code because this is really bad for the U.S. long term. But in any event, here's the final multiple I want to talk about, which is called EV to sales, EV to revenue. Again, start with key value drivers. Rearrange, you get this formula. So EV to enterprise value multiple, the key value drivers, get you this. This gets you that. This part is the formula for EV to EBIT. So enterprise value to sales equals margin times EV to EBIT. So here's the nice thing. If I take my EV to sales and I divide by the EV to EBIT, I get my estimated margin. So let's go back to Whole Foods. So WFM, US equity. So here are the calculated multiples using our templates for Whole Foods. Output Excel. Yes. So this is the outputted template for the multiples. Make it bigger. So here's what I'm going to do. Set a market cap. I don't care about the market cap column, so I'm going to say estimated margin. Equals enterprise value to sales for 2 years forward divided by enterprise value to EBIT for 2 years forward. That is the margin that the world is using today for these grocery store chains. Copy. This is the long-term margin that the market's using for Whole Foods. 5.2%. So, when we did the as-is valuation, this is EBIT, and that needs to be 5.2%. Because that's what the market's actually using. So this is what I told you a week ago was actually hiding in plain sight. I'm just telling you how to unearth it. So I know that long term, somewhere around 5.2% is the margin that people are using based on the share prices that are trading today. So here's the point, 5.2. Oh, sorry. To get to 5.2, I got to make this 8.1. Sorry. And can't change the white cells. And that gets me to a $34 share price. So by the way, there you go. Now I'm close. As I said, I'll probably smooth out the margin enhancements. But if you really want to look at the as-is, that's what the market's looking for. They're looking for growth of about 3% for Whole Foods. And they're looking for margins around 5.2 for Whole Foods. That's in the as-is. Now, whether we agree with it nor buy, sell, hold, that's okay. But as I said, you guys kind of used some logic earlier today to come up with this. And that's why I said, give me about 40 minutes and I'll give you my logic for the hold. Because I think that's the margins that the market's using. And then the question is, what do I think about their margins compared to their peers? Well, they're still trading at a premium to the industry. And for competitive reasons that everybody talked about, I don't see their margins going up over time. I actually see their margins stabilizing or going down from that point. Hence, I'm on the hold category. All right, so this reinforces the as-is and reinforces what you're going to do for your analysis. So what you then need to do is you need to take this file, save it, and save it as a Excel model. And I'll call this the multiples. And I will put this in the security on my Excel has gotten to be extremely annoying. But I'm going to put it in my downloads folder as a Excel template. And then I'm going to go back to our Whole Foods model and I'm going to add this as a final tab. So in our Excel model, you are going to put in a final tab called multiples. And that will be part of your homework for Wednesday that you're going to do. And it will be part of your group project that you're going to do. So put this in the downloads folder. Excel, call this multiples. And then once it's saved, I want to put it into close out of all these. Take our model, open up the spreadsheet we just did, called multiples, and then basically rename this worksheet multiples, right click, move or copy. I want to put it into my Whole Foods model. I want to move it to the end, hit OK, so that this is now part of my Whole Foods spreadsheet. That's what you're going to use for your next homework assignment. That's what you're going to use for your group project. So you will basically do this analysis in addition to the analysis you just did to help you with the baseline and to help you explain what's going on. The other difference is that you should be able to go through company by company and rank who has higher or lower spreads and growth rates relative to the peers and why people are trading at premiums or discounts. Right? So you need to be able to explain that. So why is Lockheed Martin trading at a premium to the rest of the industry? Right? Why is Raytheon trading at a premium but less of a premium than Lockheed Martin? You should be able to explain that using the multiple analysis that we just talked about, doing it directionally. That is your next homework assignment. So I'll pause here to ask for questions because I've given you enough information to do your next graded assignment. But if you have any questions, now's a good time to ask. Yes?
Where'd you get the 3%?
Which one? The 3.8?
No, in the, when you move it over to the ratios, and you put for revenue.
So what I did, and I'm a bad analyst here. So what I did is I said, okay, if the EBIT gets down to 5.2, and I just kind of herky-jerky threw it from 5.5 to 5.2, okay, just very quick. Then when I did this to 5.2, this was a $34 share price. And I need to get, earlier today, Whole Foods was trading at 30.42. So I knew that on my ratios that I had already come up with a reasonable tax rate. I had already come up with a reasonable EBITDA margin that matched the analyst margin. So therefore, the only way I get back to 30 a share is I got to lower my growth rate. So 5, 4, 3. Again, I could go year by year, but that gets me really close. So what we did for the last homework is you just inferred what you thought the margin would be and what you thought the growth would be, and you just reasoned it out. There's nothing wrong with that. But what I'm telling you is let's go a step further, and let's actually use what the market is doing for margins, and let's actually apply that. Right? So just as another quick example, let me go back to Lockheed Martin. So if I go back to Lockheed Martin, the defense and aerospace industry, LMT, U.S. equity, and if I go back to Lockheed Martin and I go to our template here for multiples, output to Excel, then, and again I'll make this bigger so it's easier to see, I know that the estimated margin that's being used in the defense and aerospace industry today, prospective margins, is around a little under 12%. And I know, based on the trading multiples, that Lockheed Martin's estimated margin is 12.2, Raytheon is 13.9. Hiding there in plain sight. So when Raytheon goes to the analysts and tells the analysts that we actually have better margins than our peers, Raytheon has some of the best margins going forward in the industry. Right? But why, with those better margins, is Raytheon not trading at a higher multiple than Lockheed Martin? Well, what I can see very quickly, again, I'll make this a little bit smaller, is because for very similar spreads, even though Raytheon spread's probably a little bit higher, it's trading at lower multiples because Lockheed Martin is expected to grow that positive spread a little bit faster. So Raytheon and Lockheed Martin have similar spreads, a little bit higher at Raytheon than Lockheed Martin because they have better margins. But Lockheed Martin's growing faster. In fact, if I drill down to the first week of class, Lockheed Martin has more productivity. Raytheon has more margin. Lockheed Martin is more efficient with their use of the balance sheet. They have faster cycle times. And that faster cycle time and higher growth rate is why Lockheed Martin is trading at a premium in the industry. All right, so it's not just about the margins. And by the way, I can make every single one of those statements. I know I'm right. And I haven't seen a single financial statement. I haven't looked at an income statement. I haven't looked at a balance sheet. It's right here in the multiples. Okay, so got a couple more minutes left. Let's pick another industry. Give me any other industry. Company or industry?
Tech.
Who?
Internet.
Who? Give me a company.
Oh.
Pick a company.
PayPal.
Okay, so let's look at PayPal. Let's look at the payment space. PayPal. So here's PayPal, and here are their payment peers. Okay, so basically what I could do, again, same thing, settings, output, Excel. Again, estimated margin equals enterprise value to sales divided by enterprise value to EBIT. That is the margin that the market is using today for PayPal's industry, payment industry, and for PayPal itself, 21.6. So PayPal has below average margins compared to their payment peers. Now what's interesting is PayPal relative to the industry group that it's in. Again, their price to book multiple is lower. Maybe that's distorted. Their PEG is lower, which suggests a lower ROIC. Their growth is higher. And PayPal is trading at a discount to enterprise value to EBITDA and enterprise value to EBIT. But due to PE, which is based on cap structure differences and non-operating differences, they traded a similar PE. But what could be happening is PayPal could be levered up, and some of these other firms could be all equity. I don't know, but that would be one thing I'd want to investigate as I looked across the firms. But what I do know is PayPal is a lower margin firm, and PayPal is expected to grow faster than the industry. So that's actually why they're trading at a little bit of premium to the enterprise value multiples, because the market is valuing their growth more so than their margins. And that's what I'm telling you is very quickly, you're going to start through practice to look at this data and gain tremendous insight that a lot of other people don't know how to do. And I'm telling you, this is advanced. This is not basic. They don't teach you this in other classes. But if you understand this, it'll help you really start to be able to explain these multiples and why companies trade where they trade. And by the way, here's another reason why what you've learned before works against you. And I'll show you this final thing as we talk about this. Let's say we're doing Google, which is Alphabet. So again, I'll go to Bloomberg, and let me just look at Google real quick. So I go to Google, and the first thing I look at is what is their growth rate. And I'll use growth in sales as a proxy. But here's the problem we would have with traditional multiples analysis for Google. Right now, Google's 2016 and their current multiple is around 21.5. So here's what a typical naive analyst would do. They'll say, okay, Google grows $1 of earnings per share. Their multiple is 21.5. Therefore, their stock price will go up $21.50. And that's how I'll set my target stock price. And if Google grows another dollar the next year, they'll go up another $21. So if they give me $2 of earnings growth in the next 2 years, their stock price will go up $42 because Google will trade at a 21 times multiple times earnings, and that's the price. Here's why that's naive. Law of large numbers. As Google gets bigger, it's harder to maintain the same growth rates. Look at what happens to their growth rates as they get bigger. So here's the thing. If multiples are a function of growth and return, growth and spread, then as the growth rate comes down, the multiple comes down. So in 2 years, $2 of earnings growth are not multiplied by 21.5, they're multiplied by 18.4, because if you run through the key value drivers, a lower expected growth rate at that time leads to a lower multiple at that time. So they don't trade at the same multiple that they trade at today into the future. And that's how I can misprice Google, because I'll assume that they'll trade on future earnings at 21.5. But that's naive, because when they get bigger, they're not going to maintain their growth rate, and at a lower growth rate, they'll have a different multiple. That's why finding comparables is so important. It doesn't mean that Apple is bad, because Apple trades, and again, look here at the RV screen. It doesn't mean that Apple is bad because Apple is trading at a PE of PE, of 11 and Google's trading at a PE of 18.4, what it means is they have different levels of growth and spread. Apple is not growing, and with no growth, this great return gets them a PE of 11. So again, if I switched here to Apple, and I look at their EEO, Apple is not expected to, they're actually expected to shrink next year, and then low single digit growth. Well, that's a different PE when you run it through our formula than a company that's growing at 10 to 15% a year. So that's what I'm telling you, is that when they talk about comparables, this is why it's harder to make Apple and Google truly comparable. Because as the growth rates are different, the multiples will be different. So you can't say that Apple's undervalued because Apple trades at 11 times earnings and therefore should trade at 16. That's a naive statement. Why would Apple trade at 16? What would have to happen to Apple? What would have to happen to Apple to trade at 16 times earnings? Yeah. Exactly. They'd need growth rate approaching 10 to 12%. Then they'll trade at the same multiple as Google. So that's what I'm saying. Like an analyst will say, gee, Apple's undervalued because Apple, you can buy Apple for 11, Google's at 16, and Apple should be trading at 16 because Google trades at 16. And when these two companies are mixed together, then therefore you're going to get a deal on Apple. No, that's not the way it's going to work. The reason Google's going to eventually trade at 16 is because Google's growth is going to slow to 10%. Apple's never going to get to 10% anytime soon unless something major happens that is unexpected in the marketplace as a $220 billion company. So therefore, they really won't have the same multiples, and Apple may actually be very fairly priced, not underpriced when people look at multiples. And I want you to understand every single word that I just said and be able to repeat that. That will be a good chunk of your final exam. When I talk about your final exam, this is going to be heavily explained on a final exam. I'll give you data, you're just going to write out stories. In your group project, which you're submitting in 2 weeks, you're going to write out stories. You're going to talk about it in 2 or 3 pages and explain what's going on in your industry and what's happening with your company. And for your next homework assignment, that's your next homework assignment. So let's talk about your next homework assignment. Your next homework assignment, which will be due 1 week from today, is basically a repeat of the last one plus multiples, because that completes out the project. Okay? So here's what it's going to involve. In about an hour and a half, because I don't want the next class to do the homework assignment during class, basically I'm going to post the next homework assignment, and I'll give you another company. It won't be Whole Foods, but it'll be a company you've heard of, you've probably personally experienced, and it'll be in a completely different industry. You're going to have to do the as-is valuation, now including the multiples, to give you a better as-is, plus your bull, bear, and target, and write all that up. Then a multiples analysis on top of that, where you explain why the company's trading at a premium or discount and what stories can be told across their multiples. So you're definitely on the 1,000-word side versus the 500-word side. It's going to be due a week from today. So Wednesday, no class. It's a lab. So you get to have class time to work on this assignment. And bonus number 2, which I was going back and forth on, but I'm going to do it this way. It's a group project. So your next homework assignment, I'll let you do as your group. Same group that you're doing for Stock Track and the group valuation project, because this is a preview of what you have to turn in 2 weeks. So I'll let you work on it together as a group. One person will turn it in on behalf of the group. So again, I'm going to be nice on this. However, I will tell you that a very large proportion of the final exam will be on multiples and explaining it. So if you're just like, group, do all this work for me and I don't really care, you probably won't do well in the final exam. So it is in your personal interest to know what's going on here. But that being said, I know we got a lot of work to do. So between now and the next 2 weeks, because you should be working on your group projects. So I think getting you involved with your group working on this would be beneficial. Yes?
Just about the group project, how long is the presentation?
10 minutes. 2.5 minutes per section, including the multiples analysis that I just did. So, but paper-wise, each section, multiples, you're going to write up about 3 or 4 pages. So each section's about 3 or 4 page written, but the presentation's only 10 minutes to cover all 4 sections. But these are the final 2 sections. So really what you're practicing for the next homework assignment is the dry run for your paper, and it's probably even a similar length. That's why I'm making it a group project, right? So it'll be good practice for you. All right, so again, check at about 4:45, and you'll see what the company is. There is no class on Wednesday. I'm giving you class time as a lab to work on this as a group, and it's due next Monday at 10 a.m. for all sections. So because I'm giving you class time on Wednesday, no extensions, and it's a group project. So all groups should turn it in. One person will turn it in on behalf of the group. Yeah. Yes, I'll also be posting an announcement with all the requirements, but we pretty much covered what all they are as of today. Okay, other questions? Great, I'll see everybody 1 week from today.